What's going on? The market's really on a tear this week, by and large, after last week sort of selling off a bit, despite the inflation, despite the virus. Why?
David, great to be on with you today. And it's again about COVID, right? COVID news were really bad when we heard about Omicron, and COVID news this week as people got more data on Omicron, and not that it's not a problem, but seems to be milder, seems to be spreading, but not, not as scary as some variants could have been, I think has calmed the market. Plus, people are sort of moving on where there's more clarity on the Fed position on both taper and probably interest rate increases. But of course, we have the inflation scare at the same time coming up.
Well, and that was the question. How sure are we about the Fed? I mean, Jay Powell has made it clear they're going to advance, it appears, in the next meeting coming up, the tapering of the bond buying. But some people are saying he's going to go faster than even he thinks, and they may end up at a higher point. What do you think? And can he do that without really rocking the boat so much that it hurts the economy?
I agree that tapering will start sooner and go faster than was his original plan. And I think that it is overdue. But the important thing is that the Fed has really got two jobs, right? It's inflation and employment. And on the employment side, there is sort of a new twist that both, you may remember, Treasury Secretary Janet Yellen has been emphasizing, but so has Fed Chair Powell, which is equitable employment and more equity in growth. And I think that is where it may lead to slightly different actions, which might mean that while inflation, is about 6.8%, it might go up to close to 7% and peak around 7%. But my view is that it will come down to about half of that, towards the end of next year as these supply chains go away, but also as hopefully some of the Build Back Better actual actions get implemented and we start having some of these supply chain issues get resolved a little faster.
Afsaneh, you at RockCreek are an investor rather than a trader, so you look over the longer term. You're not in and out of the market, as I understand it, constantly. At the same time, some people are saying now we should get used to higher inflation, not 6.8%, but significantly higher than we have on trend. If it's true, if we're set for 3% or even 4%, Larry Summers is now saying maybe 4%, what does that do to an investor? How does that change your portfolio?
So two things. One is depends on how this inflation gets translated. For example, a lot of people say, wages are going up and that's a bad thing. But really, in Economics 101, depends on exactly where the wage growth is happening. If the wage growth is happening at the lowest income levels, and that is actually the case, but don't forget, those wages are so very low that 20% increase is very little on a very small base, right? So if you have higher growth on wages, what you're going to have is potentially more ability to buy goods by that group, which has a higher consumption rate than higher income goods, and higher growth in the longer run. Now, the other side of this is, as I think some of these very short, I would call it shorter term, not just supply chain, but the fact that people were reading about inflation got them to buying more. The fact that we have some issues with specific issues because of COVID that happened with, for example, not, car companies selling their fleets or not investing last year. We're seeing that impact this year. As they invest next year, we're not going to have those same pressures. So, we might be closer to, my assumption is closer to 3.5%, but that will go down over time. So not so concerned about that.
So Afsaneh, let's take a global for a moment, because you really are a global investor. What are the differentiating positions among different countries? We see Europe with a slower inflation rate. China's in a very different place. Where are there really disparities that may be an opportunity for investors?
So really interestingly, in Japan, you saw very high inflation rates come out recently as well, in terms of their factory goods coming out of factories. We're experiencing higher inflation. The very interesting areas in Asia also are countries outside of China, Southeast Asia, India, but also some of the smaller countries in East Asia, because as all the geopolitical issues are going on, but also all the things that are going on in China, those other countries are beneficiaries in terms of both the higher growth rate and better control over COVID, but also the fact that they will benefit from diversification of imports into other countries. Europe, you're absolutely right. And we have seen at the ECB that the wording is changing a little bit more gradually than in the US. But we know also in Germany, the inflation fears are very strong historically. So I wouldn't be surprised if the language starts changing a little bit faster in Europe as well in terms of their tapering, their version of tapering, and potentially starting to think about interest rates increases. Everyone is saying that will be a 2023 event. I wouldn't be surprised if it's a 2022 event. But let's also not forget, everyone is talking about these small 0.25% increases, which is what has been our experience since Fed Chair Volcker was in power.